Welcome to the Dividend Talk podcast, episode 282. Why dividend investors are not panicking during the Bitcoin bloodbath. European DJI, it's been a crazy week. I don't know if you've been on social media much. There's a lot of panic. There's a lot of fear. Everything is crashing. But how are you feeling? Are you calm? Are you relaxed?
I'm very calm. I'm very calm about this. I mean, come on, I think it's actually giving opportunities. And you know, we use the term crashing here. This is, of course, not a great financial crash that we're talking about. I think this is very much sector related that we're talking about today. So that's probably a really important nuance, because I think the Dow Jones just hit another record high ever. Is it 50,000 points or something like that? So
yeah.
When we talk about crashing, I think there's a lot of panic in some areas on social media, for instance, or in the stock market news. Bitcoin, for instance, it was trading 120K not too long ago. It dumped all the way to 60. Oh, that's a large drawdown, right? So we see the same with a lot of SaaS stocks.
Yeah. Look, we'll get into that. We'll get into that in the main topic in about 20 minutes or so. But before that...
Yeah, I need to talk with you first. Or do you want to do the disclaimer?
Let's do the disclaimer. Let's get the disclaimer out of the way.
Okay.
We've a lot to talk about on the show, but this podcast is for our entertainment. Nothing we talk about, none of the companies should be considered as financial advice. Now, hit me with it.
Okay, so yeah, you said SaaS stocks, right, going down?
Yes.
So what about Microsoft under 400 or at 400? What do you think about it? Are you happy with a price in that place?
I mean, we spoke about this last week. You pushed me and I said we would buy one under 400. So yeah, Microsoft, I mean, if you look at all these big seven companies, aside from NVIDIA, who seem to be doing quite well, Microsoft seem to be coming into a more reasonably priced area on a PE basis, which is kind of surface level, but certainly looks interesting at that price, doesn't it?
Definitely, and I'm sure that it helped a lot that the community has been supporting you, because I did a fundraiser, and it's called Derek's first Microsoft share funding round. People could buy a coffee for €5 for you, and I would just want to mention that we have an amazing community, because we collected €145 in one evening for you, which is about $170, so that you could finally really buy your first Microsoft share. So I hope you appreciate the contribution, and I want to call them out, because Derek, I don't want you to ever forget them, because this share will probably go through multiple share splits. It will create later 100 shares for you 30 years from now. Your children will be inheriting them. They will be getting all the dividends, all the wealth. It will be the Coca-Cola of 30 years from now when we talk about Berkshire. Like, if you would have bought this stock at 400 in 2026, you would have made like 1,000 a month in dividends right now. Yeah. So please print these people in your mind, because those are your Patreons, those people that really care about you and your family. And Nikhil, Tom, Meerdat, Adrian, Hussein, Vil, Marcus, Lars Erik, Evangelos, Dino, Marcus, the passive engineer, Manny, Sander, Patrick, Reiko, Daunius, George, and Kim. Thank you, everybody, for your really contribution to Derek's first share, the funding round here.
Yeah, you're all amazing. I get a bit awkward with this stuff. I know you put it out there, and I was sitting in the background, but I do appreciate it very, very much. And I have bought that share under 400 already. I have a screenshot. I think I sent it to you. So I'm a man of my word. But again, appreciate the contributions and the coffee. My kids will be happy.
Don't you? We'll get you this share. So here you have it. Thank you once again, everyone, for this. I don't know, in Dutch we say ludieke actie. I don't know what it is in English, but we have you. Now you can finally say you're a Microsoft shareholder with pride.
Yes, I have that one share. Now it is a time that I start building that out. So it's probably worth a deep dive, or at least...
Yeah, and don't sell it, right? Thinking you got $170 discount on the purchase and think like, no, it's not a profit for 400.
No. This is one I will never sell. It will stay in my portfolio forever.
Oh, that's what we want to hear. Thank you so much.
Yeah. Yeah, it's a forever one. Anyway, let's move on to, because we've got a lot to get through. So let's go on to the news of the week. And this one popped up on Discord from Bertrand, and it's around the French finance bill. They introduced a temporary exceptional corporate tax income, CTI, for large companies that exceed 1 billion, with rates up to 41.2% for those over 3 billion.
41.
You know, we like to 41
41
billion.
Yeah.
You know, we like to invest in these types of large companies. So, I mean, this will have an impact on us, I assume.
Yeah, so it's not new news, right? But it's entering now the annual reports. First time that we discuss about it, it was a bit of a surprise to me as well, because I was not aware of it as such. But yeah, this is crazy, right? This is the typical tax to billionaires mindset that is surfacing here in France. Those companies that are already paying a large share of tax in France are even being hit more with the tax. I find it just criminal. It's just like literally like, okay, we as politicians, we find it hard to make decisions, but we're good with wasting other people's money. Yeah, and that's typically happening here, in my opinion. I really don't like this. And call me right winged or whatever it is. I don't really look at it like that. I just feel like it needs to go both ways. If a society is under pressure, then yeah, you cannot only all the time take the money from your golden goose. Yeah, because at a certain moment the golden goose flies away or stops making golden eggs. Yeah, and that's the risk that I see here with France. I also don't have a lot of pity feeling for corporates as such, right? Even though I invest in them. They also have avoided a lot of tax over the years. So think about Apple in Ireland as an example. Yeah, but I find this a little bit absurd. 20.6% surtax for companies with an annual revenue between 1 and 3 billion, and 41.2% surtax for more than 3 billion. Come on, guys. Come on. So what is important to know here is that this is applying for the 2025 fiscal year, but they also have, as per my knowledge, adopted already that this measure will be also happening in 2026. And we know how it goes. Some taxes, they are put in as a temporary measure and they last for 20, 30 years, right? What is also important to know is this is generally over, let's say, the tax or over the revenue and the income in France. If you take Louis Vuitton as an example, it makes a certain amount in France, but it has a company in every country it operates, right? So they are quite clever enough to make sure that they pay their taxes then and more in those areas where it suits them better. But this is, for me, it's worrisome because I've got half of my portfolio invested in Europe. And if many companies, many countries in Europe will do this, it will put the free cash flow under pressure and potentially my dividends.
Yeah. I can't see Ireland doing it, so we might get more companies over this way. We keep the tax rate low for companies for a reason. But in my experience, when temporary measures are introduced, it generally stays longer than what they anticipate. Because when they get that income stream, it's hard to let that go, right? It's hard. And we had that in Ireland on a personal, individual level. We had this USC charge that was touted as temporary, and now it's just part of the fabric, and they increase it every couple of years. So yeah, it's definitely worrying though as an investor, especially if pan-European adoption comes out of this. So it's one to watch.
Or invest in microcaps.
Yeah, exactly.
Just as long as you have dividend growth stocks under the 1 billion in France, you are better off. And you still get the dividend tax in France, right? We haven't even mentioned that.
Oh, yeah.
But it makes France more and more uninvestable. If you have a pure French player in terms of revenue, it makes it more and more uninvestable.
Yeah, they don't make it easy, do they? They don't make it easy.
And then they want, this van der Leyen wants to have a pan-European investment network and all those barriers gone. But my God, we're far away from that. And then Macron also decided to invest 30 million in AI. by taking 40 researchers or something like that into France, 30 million. And then we're talking about 600 plus billion in capex that Nvidia is talking about that's coming, being invested in the US. And we're talking about 30 million. Man, it's becoming a running joke. It's unbelievable, right? Unbelievable.
Yeah. Yeah, hey, look, we've spoke about that on numerous times. We won't go there. We'll go on to more positive news.
Yes, let's do it.
One of your favourite topics, I believe, and there's quite a few there, maybe you'll run through them for me, but dividend hikes. What have we got this week?
So first of all, Lotus Bakeries, a Belgian cookie maker, you may know them, quite tasty cookies, I must say. They hiked the dividend by 18% to €90. It's still a low yield, but it's making them a dividend aristocrat with 25 years of dividend growth. So it's a typical low yield, high growth stock. They have been beaten down a little bit, but still. Then we have a big kaboom. Wärtsilä raises the dividend from 44 cents to €1.06. I do believe it includes a special dividend. Nevertheless, this is for me the master of all kabooms so far this earnings season. Brookfield Asset Management increases the dividend by 15%. Surprise, surprise. I think many people are in it for this reason here. We've spoken also about them a few times. For me, this company is on the too hard pile. It feels like General Electric with all these structures in between that it's really hard to follow the money there. So you own some?
Yeah, I own Brookfield. They've simplified that structure a little bit, but yeah, 15%. That was my biggest kaboom this week.
Oh, nice. No, I'm not making those numbers, unfortunately. So Abloy, another 8.5% dividend hike to 6.4 Swedish crowns per share. Also, Carlsberg, your favorite beer. I like to think we helped them a little bit on dividend day in Malmö, because on the Friday evening we were drinking Carlsberg. We made some nice pictures of it. A 7.4% dividend hike, which is interesting because alcohol is very much beaten down. Yeah, so I haven't looked at the numbers in Carlsberg, but I wonder if they were also having a good earnings report here. Equinor, the Norwegian oil company, 5.4% increase. I'm not a big fan of them because of their irregular dividend growth, but Hershey is back in the game. Last year, a flat dividend, and some people were actually selling Hershey for that reason, because it lost its aristocrat status with that in America, because they are very, very strict on this. But it hiked the dividend by 6% now because earnings started to pick up. They were just very conservative last year with the cacao prices. I emailed Hershey like several years ago, what is their dividend policy? And they said like, well, the investment trust, the trust with the orphanage school and everything very much depends on those dividends. And that's how the original founder set it up. So our incentives are very much aligned, I would say. Also, Novartis hiked the dividend by 5.7% to 3.7 Swiss franc per share. 29 years of dividend growth. PepsiCo, 4% dividend hike. My God, we're not so, convinced of the safety of the dividend. I think we have a question about it also, like whether now this hike proves that we should relax around this. No, I don't relax with it here. It's still a very high free cash flow payout ratio. Plus, they want to lower the prices. Yeah. So
I think Peter asked that question, but I think his point was more towards, I think free cash flows is projected to grow again in 2026.
Yeah, let's see. Projections are nice. Yeah, I want to see delivery, and that may mean that I miss out on an opportunity that I should have bought more. But with PepsiCo, if they tell me they are going to lower prices, then they are expecting much more volume. Yeah, and then we have GLP-1 as well and all of this. So I wonder how realistic all this is. But yeah, if they are aggressive enough, maybe it works. Their competitors are the home brands of the supermarkets. Shell hiked the dividend by 4%. We'll talk a little bit later still about Shell, and Novo Nordisk by a meager 3% as well. And we'll also talk a little bit about Novo Nordisk. One big watch out, because Evolution Gaming said that they will announce their dividend later this quarter because they want some more time, I guess, to look at their capital allocation priorities. this year. So for me, this sounds like a dividend cut, as simple as that.
Yeah. I think that's how you say we're cutting the dividend without saying you're cutting the dividend.
Yeah, that's
so.
what I mean. I hope to be surprised otherwise, but I wouldn't be surprised because they're still a bit in the category of growth stock, which seems a bit broken. So they have a lot of pressure, I think, from their investors that just say like, buy the hell back everything you can. Don't think about the dividend. While Sweden itself has a high dividend growth culture. Probably they have a lot of international investors that think different here. So I think that may be the pressure on management.
Exactly. And look, you can understand that to a certain degree. They're underperforming in terms of financial results and underperforming in terms of share price for total return investors. So you can understand their predicament there, but doesn't help us as dividend growth investors, I would say. I have a small position. Let's see what they say before.
And the earnings were not a surprise to me. We know that there's a beaten down stock at this moment in time. Still, transparency could be better. That's all the time the issue that I have with management. Not so much what they are doing, but the transparency about it. Because I don't like surprises later, or when you had some worries and they don't answer you clearly, and then later it just turns out to come 1 year later in the numbers, and it's being used as an excuse.
Especially in this type of market that they're in, transparency is key. Anyway, let's move on. Look, some nice dividend hikes. I loved the smile on your face when you were speaking about Hershey. I'm delighted that raised 6% because they came under some pressure last year. If I remember, cacao prices were high.
Yeah, they were crazy.
And Hershey was almost, if you listen to the market, dead at that time. So look, good to see them back on track again. So let's do some earnings. Will we have a couple of quick fire?
Just
5 or 6.
Just quickly, I'll start with Shell because Please. That's my biggest stock in terms of dividend income.
You got a name in Malmo. I don't know if you knew this, but you were called Shellman.
Yes, of course, I'm the Shellman. I didn't know that, but thanks for sharing with me.
I was waiting until we did earnings on Shell to say it.
I like that one. Yeah. Look. First of all, dividend hike of 4%, and they announced a new buyback again of $3.5 billion. I'll come back to those buybacks soon. What I think is important to know, the oil price for 2024 on average was between $80 and $90. If you look at Brent or the other one. And in this year, it was between 69 and 75, let's say. So low 80s versus low 70s, which is quite a decline, from that point of view. Then if we look at the gas price, that was much more stable compared to that. Henry Hub actually increased by 30%, but then the EU one decreased by 10%. So let's call it a little bit in the middle there. So what I want to say with that is quite important. If you think about this and people think about oil company, I often say it's an oil and gas company. Because half of the adjusted earnings, 1.7 billion in the fourth quarter, was from integrated gas, 1.6 from upstream, read the oil that they're pumping up. The same from the free cash flow, 4 billion came from integrated gas out of a 9.4 billion in total. So they made also 4.3 on upstream and 1.8 in chemical and products, right? This is, I think, very important. And if you look at the adjusted earnings decline, where it came mostly from compared to the quarter before, it's marketing. Think about all the gas stations you see everywhere in the countries. So I guess the margins went down there. And chemical and products. Yeah, so they're chemical plants where they're really turning oil into other products. Yeah. So I just want to remind again that people that this is nowadays at least half a gas company, and gas prices were doing relatively well. That's why it doesn't look too bad in terms of numbers when it comes to Shell. One worry in general I have is that the proved reserves from Shell, because they continued a little bit to decline over the years. It went now from 8.9 to 8.1 billion of barrels. But they had a reserve replacement rate of 73%, and the average rate over 3 years is 84%, and with a reserve life now of 7.8 years. I like a reserve life around 10 years, as an example. So this is the main worry that I have with Shell here, is that over time they're not replacing enough of their reserves. Yeah, and that's the main watch out I have with this company. But I'm liking that they're finally adding a proper slide again here, because with this whole climate change movement and everything, some companies started to drop these kinds of ratios, like I think Total Energies, but it's still very important for us as investors. Yeah. For me, it is more like creating smoke and mirrors when they take this away, because I end up calculating it myself then, which takes me much more effort. And I think they're doing that on purpose. Then there's a second watch out that I always look at, is the balance sheet. It increased to 45.7 billion, while it was 41.2 billion 3 months earlier, and a year ago it was 38.8 billion. So we see an increase of 7 billion in debt. And the gearing, let's say the net debt ratio to equity, grew from 17.7 to 20.7%. So the question is, and that's a question from Patrick as well, do you feel the share buyback risks significant debt increases? Yes, I think management is putting too much on the buybacks here, and I think they need to manage the gearing better. I like the gearing more towards 15%. So I prefer them to go to that level first, and after the dividend, only do the buyback. I think they're a bit too aggressive on this, and with that, I also think I've answered the question from Ryan as well about the buyback machine keeps going on while revenue and oil price have been getting lower and lower. So I would like. I know I just mentioned 3.5 billion buyback. Yes, this will be a lot of shares reduced again if they do like 12 billion per year on their market cap. But I feel like it's a bit too aggressive. I would watch out a little bit, because if they have a gearing of 15%, then when the oil price goes to 30 or 40, they can one time leverage up a little bit with this. Yeah, and they are now actually in still relatively good times. They are using their leverage already, and that's what I don't like.
Yeah, which I find strange, right? Because they spent so long just after COVID getting that down to a good level, aggressively reducing debt and reducing that gearing level. I can't remember the target. Maybe it was 15 or 17. But they spent so much time doing that. They got there, and now it's just like they forgot about that, and they're gearing back up again.
But at least they are transparent about it, because they have a target, and they nicely show that in 2025 they went above the target. I don't think they can predict the oil price, but maybe a few projects are coming online. Maybe there are some expectation there as well. Nevertheless, I don't like the number above 20%. Yeah.
Yeah. Great. Okay. Nice one. Quick fire. So we'll move on to one. I'll move on to Merck. It's a company that I did a deep dive on probably around 6-7 months ago, I would say. Started a position in them and have been adding to them, as you know, over the last while. I'm up to about 60 or 70, 65 shares and a bit. Merck have been under pressure because, Keytruda, right? It's coming up to this patent cliff. And we know when a company relies on the biggest selling drug in the world and there's a patent cliff coming up, they're going to be in trouble and they have to do something about that. So what I like about Merck is that they are actively going out and strengthening that pipeline. They now expect over 70 billion in commercial opportunity by the mid-2030s. They have a nice slide there which shows some of the companies, like they have nice names when they're released, but all these medical names are quite confusing when they present them in slides. The pipeline is quite strong. In 2026, 2027 and 2028, there's probably around 10 to 12 different product streams coming out of there. And that's across the whole oncology, infectious disease, immunology, and phenology as well. So across the whole range that they are doing that. MK300 is one that sticks out. They have like 6 marked as stars that are going to contribute a lot to these. And what they've done quite well to do that is they've done some acquisitions. So you've had Verona Pharma, you had one, I think, significant one in seizure therapeutics, which helps with flu without needing to get a jab. So it's doing well. The share price has seemed to to reflect that over the last 6 months, and definitely over the last week. I think it went from something like 105. And I think it's the top performing company in my portfolio this week. It was at 117, which to me is not really that important.
Nice.
It's more what they do with this pipeline. They're also coming up with other plans for Keytruda to try and prolong that patent. So look, I think overall they are doing a good job of knowing that they have to replace Keytruda, bringing in companies, buying companies, expanding their pipeline, put a lot into R&D. And yeah, quite happy with it. In terms of numbers, revenue was around 65.5 billion, which is kind of flat. They're expecting the same next year, which all things considered, when you think of the impact of Keytruda, it's not actually too bad. Earnings per share was $5 per share. They increased their dividend recently as well, maybe 3 or 4%. So yeah, I think overall it's a turnaround. It's like AbbVie-esque back when AbbVie was beaten down that much. But I like what they're doing in terms of their portfolio management. So let's see. Well, look, one to keep a close eye on. It's not the finished article yet by any means, but I think management are moving in the right direction.
Awesome. I mean, I don't own Merck, right? So, but nice to see how your conviction and how your holding is doing in this one. We always talk about how difficult big pharma is to our farmers to analyze, but I think portfolio management is much more easier to spot. So, and here, the pipeline, you see some wins, you see some misses, so it's more predictable, right? And therefore better to understand.
Exactly.
Talking about which, I do every year. I put all the top 20 pharma companies on a list, and I analyze them also in terms of exposure to their portfolio, right? Because that's the main thing we need to manage here. And for instance, we know that some companies, they have a really diverse portfolio. So the top three drugs make only up, let's say, 20% of revenue. In the case of Novo Nordisk, this is a little bit different. It makes up at the moment 75% of revenue. So if this 75% of revenue is under attack, you get in trouble. And Novo Nordisk went from $60 per share to low $40 per share, or under the 300 Danish crowns again. So it's a yo-yo. It's unbelievable. You would thought that with the new CEO there would be a bit more stability, but no way, not at all. And it's a drama. They released the Novo this new pill, right? And during the earnings call, if I remember correctly, one of the analysts said, like, "Hey, what do you think about the new pill coming in from Hims and Hers, which is a copycat there?" Luckily, the FDA yesterday, or let's say this night, mentioned that they will fight it. So they said, like, today the FDA is announcing its intent to take decisive steps to restrict GLP-1 active pharmaceutical ingredients intended for use in non-FDA approved compounded drugs that are being mass marketed by companies, including Hims and Hers and other compounding pharmacies, as similar alternatives to FDA approved drugs. This is, of course, really good for Novo Nordisk. So I expect, again, some fireworks on Monday with this when the stock market opens. But overall, right, what's more, I think, before we go into the numbers, they have now their pill, Wegovy pill, listed as the second product on the Trump RX website, where patients in America directly can buy from let's say from Novo Nordisk. So that's also a new development for $149 per month, I guess. Later it will go to $199. And Amazon, it will be priced $25 if you have insurance with them. What I want to say with this is they're now heavily already going, and they are started already cannibalizing their own product line, but also Eli Lilly's product line. If you think about Eli Lilly, it continues to grow very fast also in terms of revenue, but they need to come with a pill because also their margins will come under pressure. And what is very interesting here is when you have 2 or 3 different patents achieving the same outcome, but using slightly different technology that is patented, you can see that drug prices don't need to be expensive. Yeah, because now it's really slashed down because it's just very fierce competition. Put on top of that, because usually you have the prisoner's dilemma. If you have, let's say, Coca-Cola and Pepsi, they will not go into a price war with each other because they will both earn less. But now with a government in there that is very aggressive, you see these prices being slashed. So I'm sometimes still surprised why Eli Lilly is not yet being punished for it in the share price, because they will have to I said they will also have to cannibalize their own margins to stay competitive with this, right? And it's not just the technology in there and the drug efficiency, let's say efficacy. I think that's the English word here. Look, if you zoom out, sales grew by 6% compared to the year before. Earnings grew by 2%, and that's not what you expect from a company that was a high growth company, because the year before it was 25%. Yeah, and that's a big decline, a big deceleration. Also, they are making less free cash flow than they did in 2022. It's now at 59 billion versus 64 billion right then. So no wonder also that the dividend really increased marginally. And this is, of course, because of the increased capital expenditures. They really had to gear up their manufacturing and production there. So all in all, a poor year. Not a surprise. We've seen that CEO was ousted, new CEO in, drama continues. Though I want to give one compliment. This was probably the fastest launch I've ever seen, what they have did with Wegovy, the drug pill, compared to Ozempic or even tirzepatide from how is it, from Eli Lilly. So that's where they did really well. They are announcing also 15 billion share buyback because they want to be aggressive at these prices for the next 12 months. But just know that this is a 1.1% buyback coming up. So for me, it is like, guys, then just keep the money in your pocket here. Some watch out that you can take away from the earnings, reducing guidance. Profit would decline by 5 to 13% in 2026, putting the dividend margin a little bit under pressure. They still warn for more headwinds in terms of pricing in the US. They expect it even to go lower before it goes back up. Of course, there's some patent expirations coming for the active ingredient in Ozempic and Wegovy in several markets like China, Brazil, and Canada. Also, Eli Lilly Zepbound continues to be competitive, and they may also come with their own pill later this year, depending on hims and hers, of course, what they are doing. But we saw the news already. That said, I do really see that this launch, they really have a first mover's advantage. And now is the question, let's say the ask to the CEO, don't fuck up again. Yeah, like the last time. Also, I think there's still a lot of total addressable market ahead of them. Also internationally, I think $150 pill in European prices, 120 euros, wouldn't be too far off of what we are used to in Europe either as such. Specifically for these kinds of things, I think it's you either pay 60, 70 euros for the gym or a pill. I think the pill comes with less resistance. Yeah, let's call it like that.
Yes.
So yeah, all in all, poor numbers. It's too volatile. This is not a sleep well at night stock right now. I know it's a darling, and specifically for our Danish followers, but guys, this is not a sleep as well nights stock. I hope you're not like 60% of your portfolio invested in it, because if so, you're really a thrill seeker. For me, it's a small part of the portfolio. I don't feel that it will ever go to tier one. It couldn't ever with a 75% single product, a single disease exposure. That's the big risk. Always will be.
Yeah, they just need to stay out of the news for a bit and settle down, I think, and keep
but
going.
They don't have that luxury. They will always be in the news because this is a much debated stock. It also creates a lot of readers if you write a news article about it.
We know. We speak about them quite a lot. They come up in news items nearly every week, I would say, at this stage. Okay, nice one. Look, I think we spoke enough about Novo over the last while. Everyone knows their opinion. So we'll move on quickly. I have two more quickly before we go into the main topic. And I wanted to speak about BAM, Brookfield Asset Management. I know you said they were in the too hard pile, but let me give it to you in a simplified model. I think that the structure is difficult because you got Brookfield Corporation sitting on top, and then BAM is exactly what it says. It's the asset management entity of that. So it was spun off from Brookfield. Like BAM in its old form was a different entity what it is now, but Brookfield own 75% of Brookfield Asset Management. What that means is Brookfield Asset Management manages most of the assets for Brookfield's corporation, and Brookfield's corporation sits on top of various sort of entities in real estate and so on. So I won't get into too much on that, but BAM itself is just an asset manager. And the key metric for them is their fee-related earnings and how much they are growing. They anticipate them to go up 15% annualized over the next couple of years, and then that's where our nice 15% dividend hikes come from. So look, if we look quickly at the numbers, they reported a strong Q4 and 2025 results. Their distributable earnings, sorry, my throat is a bit sore, but their earnings is up to 2.7 billion, which is up 14% year over year. The fee-related earnings, however, was up to a record 3 billion, and that was 22% year over year, which is quite strong numbers and much greater than the 15% that they are anticipating. They raised 112 billion in capital during 2025 and invested 66 billion of this, and monetized 50 billion of equity, resulting in their fee-bearing capital growing 12% to 603 billion. Just to note that their assets under management is about 1.4 trillion at the moment. So they manage quite a lot. What I do like about them is that they are expanding into AI infrastructure. They're expanding into renewable energy infrastructure. So that they're picking up all these kind of secular trends. They're sitting on top, managing all the assets and making decent profit on all of them. So yeah, look, quick take on them. Really nice company. I do like them. I do hold a position in them. They're expecting 15% dividend increases over the next 2 or 3 years, all going well. So let's see. And I do like that they're pivoting into AI infrastructure, not AI, but the infrastructure and also the energy transition. So yeah, I think one to look at. I know they seem a little bit confusing. I think Mike over at the Dividend Guide does a great job of breaking down the whole overall structure. I'll think over the next few weeks, we've got a couple of requests to look at different entities within the structure. So I might do a proper analysis on that for that. But yeah, quite nice company, I would say. Decent results. And then quickly, we'll move on to CME. This one was interesting because I did a deep dive on them, and we've covered most of the exchanges. And even though they pay a special dividend, that's like constant. It's always there. They always pay special dividend. You never know with special dividends if they're at risk or not. But I suppose the appeal with CME is that they are growing their dividend and also the special dividend year over year. When I did a deep dive on them, I have to say I was not overly impressed. And future growth was something that I kind of questioned. However, volatility is their friend. And welcome to the world, Donald Trump, because we had a lot of volatility in the markets last year. And as such, everything went up for them. Their daily volume went up. Revenue went up, net income went up, earnings per share went up, and in tandem, their dividend went up. So I expect 2026 to be something similar. We've already seen some volatility early this year. I probably expect that to continue through the year. So I would expect 2026 to be quite similar. What's interesting is that they are moving into like the crypto space as well. So they have a section that goes into like crypto complexes. And it's quite interesting with the narrative, and we're going to get into that in a minute, that Bitcoin is now nearly dead. There's a lot of panic and stuff. But you have a big exchange like this after pivoting and moving into that, which suggests to me that maybe it's not that dead, because these guys are not stupid, right? They wouldn't invest in this if it was a dead asset. But look, that's just something to watch. Long-term growth is something I'm still unsure of. Volatility is helping them at the moment, but I mean, look, it was a record year for them, so it's hard to argue with the numbers, and they have a great dividend history. But look, one I'm watching, I don't own a position. It's just one I'm always very interested in, because I do like that they pay special dividends consistently, but that's not enough conviction for me to own this company, I have to say. Yeah. So look, two quick ones. And as always, there was probably a few more that we could have done. AMD released earnings. There was quite a few, but we can't possibly get through them all. But in the interest of time, we're hitting 40 minutes. Let's move on to our main topic. And I suppose this was influenced by a lot of the noise on social media. And actually this week, for some reason, I happened to be on social media a lot more than I usually am. I don't know if I had more time or I was just on my phone more, but I was there, but there was a lot of panic and I've seen a lot of big accounts. And what's funny is I've seen this play out before, right? I mean, you have these accounts that are pumping. Now their thesis is broken or they're selling and there's all these reasons why they're selling. But like, if you flip back 3 or 4 months, they talk about the highest conviction. This is my highest conviction pick and all the reasons. And then we see a little bit of red in the market and their thesis is broken. I struggle with that a little bit, but we won't get into that bit. Bitcoin has been struggling as well. That was down at 60,000 when I took the screenshot of this, maybe last night. That was trading at 120 at one point.
Yeah, but it was also trading at 3,000 or 4,000 when we started the podcast.
Yeah.
I mean, it's still 20x.
It's crazy, right? But I mean, we get a lot of heat. We get a lot of heat from different investor groups, right? And I'm always open. I don't think there's one way to skin a cat. I think everyone should stay in their own lane. But we get a lot of heat because total return is the name of the game. And there was an account on X, I won't say it, that alluded to that. I put in a comment saying, look, everyone has their own lane and be comfortable. They fought back with, it's all about total return. I'm like, okay. If it's all about total return, then you look at the last decades. We don't have to go too far back. And it was dividends that saved the asses of total return. Let's be honest. I think the S&P price return was basically flat or negative. So pretty much all of the total return comes from dividends during those times. I mean, when we have a bull market, it's easy to say it's all about total return. But I mean, if you have 10 years of no growth, then you're going to come back as a dividend investor. But look, I personally always think that diversification across investment strategies is a good idea. I know we are primarily dividend growth investors, but you also have a small portion in growth, yeah, and I think that's quite important. But for me, it's just a panic that I'm seeing, and I don't think this is a crash. You alluded to this earlier, and I agree with you. I do not think this is a market crash. It is more of a sector crash. I look at my portfolio. I sent you some screenshots the other day messing. I was there. I don't know why everybody's panicking. My portfolio was up 2 or 3% at the time. So it's quite interesting to see the reaction of it.
It's
online.
the same for me, by the way. If I look at year to date, my portfolio is up more than 5%. Yeah, and the dollar is still at 118 and a little bit, which was also kind of how I ended the year. So that's already almost my annual contribution in terms of new capital that I would give to my portfolio. Yeah. So I just wanna say, like, yes, tech stocks, SaaS stocks, and the Novo Nordisks and the PayPal, they are really, really going down this week. But why doesn't anyone talk about Hershey? Yeah, Hershey is now trading at $230. Yeah, just an example. Have you seen Unilever? Unilever.
Yeah.
I mean, rat of the stock exchange, right? Not even a mouse. It's at almost 61 euros now. NN Group, 68.5. It's crazy. Have you seen ExxonMobil? ExxonMobil, $149. It has been all the time trading around 100.
Yeah.
Maximum 120 for years. So all I'm trying to say is, like, this is why it's so nice to be diversified across sectors, because we have often seen that one sector can be beaten down and actually give us opportunities as long as you can handle the volatility. I think going now into some SaaS stocks, maybe with low yields but potential for high growth, could be very interesting. Here. But you need to be able to buy, have conviction in those companies, and then just think, like, okay, I'll look back at it 2 years from now. Yeah, that's what you need to do with such sectors. But then I see just a rotation going into other shares. I don't think that Unilever should be trading at 61 euro. It's probably people going out of tech stocks and trying to find a more defensive play to secure their money there. But in a portfolio, what it does in this kind of portfolio is that it really is having this leverage, right? Okay, there it goes down, there it goes up. overall it's going up, which is amazing to see, which is really amazing to see. While I'm not totally unexposed to technology, and it's not just technology, right? Also stocks like ADP, Paychecks, because they're data providers everywhere where AI could be doing something. It's scary. Wolters Kluwer, have you seen that share price collapse? We were
Yeah, it
talking
keeps
about
going.
€100. It's now in the 60s. Crazy.
Yeah, but it shows for me, like it shows about risk and risk management. And what I'm seeing online is a lot of people took on too much risk in terms of
Yes.
consolidating their portfolio or the majority of their portfolio in an industry that, let's be honest, has been sky high flying over the last 10 years. So it's
A lot of money has
easy.
been made there.
Yeah, it's easy to fall into that trap. And I suppose you fall into this bias that it's always going to go up, but history tells us something different. I mean, the signs were there before. I think even before the start of the year, there was already narratives in the media about the AI bubble, um, and stuff like that. So I don't know if that's the full story why these are crashing. I don't know why Bitcoin is crashing. I don't know why these high yield ETFs are crashing, which seem to be popping up everywhere on my feed as well. But I think it just boils down to risk.
I hear a lot about margin calls.
Yeah,
think about the sailor of MicroStrategy that has an average price of $72,000
exactly,
for Bitcoin.
It's crazy. Yeah. It's crazy, right? But look, not all growth investors are like that. I have to call out the Wildlife podcast. I listened to episode 117. I don't know if it was yesterday or the day before. And Luke has this barbell strategy to manage the risk and help him in these times. And there's definitely no panic over there. So I think you have to be clever about who you follow. I mean, you can have growth, but you can have growth and still have some sort of risk
of
factor
course.
built into it.
But it is also, in that regards, also like Joseph Carlson. He is also in very much high growth stocks, but he does really good due diligence, understands what makes a company grow, and he has been proving that over time. I think the worst now is to capitulate and sell. I mean, for me, for instance, one of the most clear stocks that will be impacted by AI somehow is Adobe. Yeah, because they will not be able to sell so many licenses there. I see it as going from AI will become the new mass-produced shoe manufacturer, while the ones that are still buying Adobe seat are those like carpenters that maybe an individual goes to for repairing their special shoe that they had, but not for the shoes you buy at the local store, only those special ones with sentiment, right? So, and this is how I see the future of Adobe. And of course, I'm now discounting and overreacting maybe a little bit because they also have this whole event management and all these other kinds of software suites, which are not so quickly impacted by AI as maybe imaging, or how is it, creating images. Yeah. But then you have SAP on the other end. Yeah, where we said last week, we said jokingly, like, how can you do vibe coding your SAP and stick it together for your manufacturing line? Yeah, so there is, I think, a whole realm in there, and I feel like they're almost all at the same time being punished a lot. Yeah, because what you also need to remember is a lot of index investing going in there. So if there's a SaaS index, yeah, it will throw everything out. Yeah, if people start selling it. That being said, how going through that and having your stock picking lens on could be giving you this once in a decade opportunity that this market is punished. Remember what I always said? I bought Apple at a 13 PE at the time.
Yeah.
Which are those stocks that are now trading at a 15 PE but still growing 20% revenue per year? Those are the interesting ones. Those are really the interesting. And then think about their business model. And I think René Selman wrote a really nice article on X. I would definitely say look him up, René Selman. He was a guest before, and he shared a little bit about a few areas to look at when you're looking at these kinds of SaaS companies. Really interesting, really good read. Working in IT, I can confirm everything what he's writing there really makes sense. And I think understanding, therefore, what he is saying and applying that to the companies that you're interested in will give you a much better view on the stickiness of their business model compared to the risk that AI may pose on it. But now for me, I'm really looking into this area now to feel like, okay, is there something to gobble up there? Maybe a lower yield for now, but I have some space in my growth part of the portfolio. On the other end, if those are dividends that could grow by 10-15% per year, maybe I'll nip in a little bit there, but because some of them, they have only a 20 or 25% payout ratio.
Yeah, yeah. And if the growth is there, I mean, if they're beaten down, like you said, and giving us a 15 PE and nearly double digit growth, it's probably even worth having a small position, even if the yield is low, not from an income perspective, but from this total return perspective that
Just
just
future
to have.
portfolio. Think about your
Exactly.
portfolio then in 10 years from now, right? Because I have an overexposure a little bit to some of the high yielders. And so I have an effort already for a few years to increase more quality. I've been doing that, I think, with my positions in ADP, Euronext, Altus Clure as well. So yeah, now's the time, I feel. But that's why I'm not panicking. That's so nice to see your portfolio going up. And, I often talk about my tier 4 system. I often get questions about it. I think I need to write a little bit more about it. I'm not the person like Ray Dalio that can invest in 10 to 12 stocks. I would not sleep well at night with that, because I would see too much dividend cut risk. And this tier system is really against my own stupidity. We all make mistakes. We all fall in love with a stock. We all misread a stock as well. And we're in the business of stock picking here, because ETFs are not a really good alternative for us. So we'll build our own ETF. Yeah.
Yeah. Yeah.
But that's why I sleep well at night. I don't panic. I think if there would be like a COVID area and you see your portfolio in total going down 20% because everything is being sold, yeah, that's a different story, right? Would I be panicking? No, I went through this a few times. Yeah, so I'm used to this. I know how to deal with my fears or my feelings at the moment.
Yeah, yeah. And I tell you why I don't panic and why panic. I rarely look at the share price, if I'm honest. Sometimes I'm triggered to look at it with different things in the market, but one of the reasons why panic doesn't really come into my emotions is we have this, well, I don't know, 5 pillars sounds cheesy, but we have this like 5-question dividend safety test that we follow for all our companies. We share this obviously with our deep dives, but we obviously do that for ourselves, for our own portfolios, right? And it's all around growth. Is revenue, EPS, is that actually moving up? I mean, what are their prospects? I take Merck, for example, the pipeline, that's where I feel the future growth will come from. The balance sheet, what's the debt like, interest coverage, all these types of questions. Affordability, can they even afford a dividend? A lot of people look at earnings. I personally prefer free cash flow. I like to see that ratio under 70. And then what is the commitment like? Do they have a dividend first culture? But remember, I'm a dividend growth investor. If you're a growth investor, maybe the affordability commitment doesn't come in there, but definitely growth prospects, balance sheet. It's the same whether it's dividend growth or a growth company. Basically, what you want is a strong fundamentally company that's going to grow year over year. And I think that transfers across different types of investing styles. And I think if you do that, that's where you build conviction. None of this highest conviction this year, but you actually have conviction, know what you know. So if you had Microsoft, for example, and it's dropped 20% from highs, not panicking because you know exactly what their products offer. You know that the overall sector is struggling. Maybe that's why they're dropping. You know, this narrative about CapEx into AI and how they're going to monetize that. That's probably a big question. But then you look at the products, you look at their history, you look at management, you look past all these things, and your conviction will tell you, okay, they are growing. We know what the prospects are. The balance sheet is strong as heck. So that
Yeah, and
they
you
might
also
be
have a
worth.
feeling for what the price should be. Yeah. So, for instance, for me at $500, I felt it was overvalued. So, if it then drops to $400, I don't necessarily think like, oh, I lost $100. No, I think like, no, it shouldn't be at $500 in the first place.
Yeah,
Yeah.
but the price only matters to me when I'm buying. It
At the
doesn't
moment you
matter
buy,
to
and
me.
at the moment if you would ever sell it.
Exactly, exactly. So hopefully you don't want to sell these types of companies, but day to day, month to month, year to year, share price doesn't really come into it. Fundamentals first, then share price.
Yes, and I always argue like study your portfolio during peaceful times. Yeah, because then you know whether something is overvalued or not. You know, whether you want to own this or not. Yeah, don't suddenly start to question when the share price drops with 25%. And then, because then the beers will be really much having the narrative everywhere, and you may start selling at maybe the bottom at that time. Yeah. So if you do your homework in peaceful times, when the stock, like in the summer, when the stock market is doing nothing, study it and really try to understand what you own. And if then there's an AI risk, you can really so something new, let's say, you can really quickly check your thesis. You can check a little bit the data. Okay, how much AI exposure is there potentially? And you make up your mind. There.
Yeah.
But if you haven't done that homework in there and suddenly you see all this negativity, it's hard to keep your head cool.
Yeah. And you're like, doing research full of emotion is going to be really, really difficult. And like, let's be honest, most people's research will be, they might click into the investor relations site, but most of it may be done on Google, right? And they look at different types of news articles. And if the share price is dropping and all you're seeing is down, 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 expectations down, guidance down, naturally you will have a picture in your head that this is bad. And you might not be looking at it from it.
This is the same if you would go to the pub in Ireland and you're a bit drunk, and then suddenly you wake up in the morning with someone besides you. It was probably not the right decision. It looks pretty in the evening, but in the morning you think like, what the hell? So
yeah, you're investing full of emotion at that time.
Exactly. So and not thinking clear. Yeah.
Yeah, exactly. I mean, we look at all these different types of stocks, and we were called like nearly fools, for example, for not being in crypto or Bitcoin, not having this, especially when it's ripping up to 120,000. It was a store of value, is what it was called. It's changing the game. When I look at Bitcoin, I can't help but think of the greater fool theory. But you know what that is, yeah?
Mm-hmm.
You need a bigger fool than you to pay more than what you paid for that, to make money on it.
Yeah, it's a pyramid scheme of fools.
Exactly. Whereas I prefer to invest in assets and companies that have a service, that have a purpose, that are tangible, that like you can see what they do to make money. Like for example, if you owned Shell, if everybody stopped trading Shell at this moment in time, they would still make cash, they would still sell oil, they would still do all this stuff. Whereas Bitcoin, if nobody trades them, what do you have? Nothing. You have like a digital string on your PC, but it means nothing to nobody.
And but volatility is not the same, right? So I'm with you on the line of thinking. I just want to say about Bitcoin, it went from 3,000, it's still at 60,000 or 70,000. If you were a total return investor, the only asset you should have invested in is Bitcoin over the last decade, even with the price today. Yeah, because volatility is maybe higher, but in terms of performance, it's probably the best asset class that you should have invested in. Now the question is for how long. But if you would cash out now, you would have been the hero. Yeah, and there's one other thing that I think would change the game for Bitcoin fundamentally forever, is that all the big banks are in it now. And all the ETFs that have been created. That is for me the moment that I feel like, okay, now it's more going to the direction of gold. You can also say like gold is something. Yeah, but to turn gold into jewelry and everything, it's also a far sought commodity, as I would say it. So I see a bit of here with Bitcoin, and I do believe more and more with what has happened and how the world is geopolitically becoming more and more difficult, that Bitcoin, there are more and more use cases in that area for the psychology, I think, where Bitcoin may have a place. I'm not investing in it as such because, to your point, I prefer cash flowing assets, and I'm okay with missing out. But I think the Bitcoin thesis of why owning it only became stronger over the last 2 years with all the institutions coming into it. Still, it could be tulips, right? Don't get me wrong.
It could be anything. But what was the main reason you heard people? What was the main investment thesis you heard for Bitcoin?
To the moon.
No, it wasn't that. No. It was a store of value. It's digital gold. It's a store of value. That's what it is. But that is simply not true.
That's not how I see it either. No, but I do see now that it became a hedge to many people's portfolios, institutions, And that's what I see. What really, for me, and at least in my mindset, changed the game. There, the moment that the indexing came in, people, financial advisors start recommending to have, let's say, 5 to 10% exposure in your portfolios. I think that changed the entire ball game. And now also the banks have a reason to advise it because they get the fees out of it. So it's an entirely new business model for them, and they will protect that as long as possible. And that's why I see a continued liquidity coming into this.
Yeah. I can see that, but Bitcoin itself, I don't really see the use case for that. The technology behind that, the blockchain, that's probably what the banks are using, but they don't need Bitcoin to do that.
Exactly.
Really. Do you know what I mean? So look, I'm like you. I prefer to invest in companies that in cold, hard assets that produce cash flow. Shell, I gave an example of. I was going to say BAM on this, but if I wanted to give a European perspective, Vopak, big storage infrastructure, connects
nice
the
deep
world.
dive coming up on that this weekend, right? So if you're not,
which is why it's fresh in my head. But it's these types of companies that you don't even know that you need that are working in the background. Merck also. So look, they're types of companies I prefer, and it helps me stay grounded. I mean, we're human. Sometimes I look at Bitcoin and I feel like, damn, if I have my portfolio in that, I'm missing out, and it's only natural. But then when you see this type of volatility, this type of panic, if I owned a Bitcoin right now with my portfolio, I would be panicking because it's not tangible. So yeah, I think for me, those are the key reasons I don't really panic.
Yeah. Good. Hey, let's do a lightning round on questions now. I think we're at that time of the show. We're on the hour already. It goes really fast, and I know you're under time pressure to stop early.
I've got about 5 or 6 minutes. We got about 30 questions. Sorry, when I say 30, no one can understand me. We've got about 29 questions. Okay.
Yeah. Okay. Good.
But we won't get through them all. So look, we'll do a couple, and then we'll keep the rest, and we'll put them into a spreadsheet, and we'll do them next week. So we won't have to ask for questions again next week.
Yeah.
Okay, let's start with the first one from Tim Ainley. He said, "We know the psychology of being price anchored, and it's tough, and that averaging into your stocks as the price increases is even tougher. Do you have any techniques you use, and is it an idea to get an investment psychologist onto the show as a topic?"
It's an idea. How I look at it, just look at the yield and what you think is fairly valued, and try to. What I do, I don't look at the buying price. Yeah, and that's why I've been averaging up also on Iberdrola. Just think about, okay, is for instance the fair value, what is it, and is the yield good, and just buy. Share prices over the next 30 years usually go up, so you will be always price anchored to your initial buy then for most of your portfolio, which makes no sense. So just figure out what the fair value is, recalculate it again. Don't look at what you purchased it for, even if you remember it. Try to ignore that and just look at, is the yield meeting my requirements after that? Is it a good business? Buy more. I bought more shares of, I bought 40 shares in Microsoft at $40 and 20 at $80. Yeah, 60 shares, now my second largest position in the portfolio.
Yeah, I suppose it depends on your conviction in the company as well and what you see their future growth. But I think someone on this show, I don't know if it was a guest or if it was you, but one piece of advice that we got was forget that you own the company. And if you would buy them now, if they're not in your company, then you should answer with that price. And I think that was a very good piece of advice, I would say. So that would be one technique I would use. I don't know if I want a psychologist on the show. They might.
I like that idea. I like that idea.
I'm joking. If anyone knows one, let's reach out and one on the show. Fire engineer, do you automatically sell a holding if the dividend is cut? Let's take Evolution, for example. Will that be an automatic sell, or would you zoom out and tolerate a fluctuating dividend as long as the trend is upwards?
It's a tricky one. It's really a tricky one. Most of the times I straight away sell because my thesis is broken around that. But I haven't done it a few times because I really saw a clear reason why, and I was supportive to a dividend cut. For evolution, I still need to look a little bit deeper in the detail. I can't make up my mind, but a dividend cut for me will be very disappointing. Very disappointing.
Yeah, but you know, one of the things we do in our deep dive is we look at the dividend policy. It's something that we state in all our stock cards, all our deep dives, and I think that's important to know. So if you have a company who state 35 to 50% of earnings, which is typical for European companies within that range, and you know that they've gone through one or two tough years, maybe they had to increase a little bit of capex to expand projects, but that's going to benefit them in 1 to 2 years' time. They've cut the dividend because it's in line with the dividend policy. I think that is different than when a company unexpectedly cuts it. I've come into trouble that maybe you did not know about or they lied about or something. So it's not an automatic sell for me. It is case by case. It's about knowing what you own, understanding what you own. And if I'm not expecting a dividend cut, then I'm more likely wanting to sell. But if I know a company may cut it, but there's a good reason, then I'm more likely
because a
going to
lot of
hold on to
capital
it.
loss may then be involved, while you know that they're kind of at the bottom of their cycle with earnings and probably the dividend therefore as well. So then after that, the only way is up. Yeah.
Yeah,
But
yeah.
I think
BFC, Intel.
yeah, it's really the difference between a broken stock and a stock with potential. Yeah.
Yeah, exactly. We have a question about currency risks, and it's from Lawrence. What would you do in a situation where you are fully invested in a US company? You plan to hold for the long term as you believe in the company, but due to the weakening of the dollar and you're down a decent amount in your position, are you tempted to buy more even though you have a full position to help with dollar cost averaging?
Tempted, yes, but not doing because the dollar can strengthen again to euro parity.
Yeah, but again, this falls into the world of total return, right? You're looking at dollar cost averaging to make the most bang for your buck. For me, it's not tempted to do that to help with dollar cost averaging. To me, if I want to do it, it's to increase my position, to grow my cash flow, to grow my income. But if I have a full position, currency doesn't really come into it. No, I'm not going to buy more because of the currency. It's not my temptation. Two more. I'll let you pick. We've got a lot of questions, so pick one that interests you here.
Maybe this one, Connor McCarthy on Facebook, I believe. He's having a general question, and his question is more like, and he's talking about the car industry and everything, and that Mercedes and Volkswagen are predicting US sales to increase by 7 to 10% next year. But then General Motors is warning of a slowdown. He says, like, aside from free cash flow, debt levels, etc., what are important metrics to use when researching a company's potential future, regardless of industry, especially when management can be duplicitous?
I think that's quite difficult to pick metrics that you can have regardless of the industry. I mean, we all know that the free cash flow, debt P rate, we all know the main ones, but I think when you go industry by industry, there's some metrics that will be better for others. Like some of them capex heavy, you might want to look at EBITDA, for example, because they have a lot of depreciation, they have a lot of that on the income statement. Or you have software companies that might have a lot of amortization. So I think metrics is quite difficult.
Metrics you need to understand. I think the 5 questions again. I mean, we come back to it, right? Is the company growing and does it have potential to grow? Are the dividend metrics in terms of payout, are they healthy? But then think about whether it's cyclical industry or not. Do they have a good balance sheet? And what's their commitment to the dividend? I think that, and for that, you may have some industry specific metrics that you need to look at it. I think it's a danger to look actually at a few metrics only and not grasping the industry. I understand you want to do comparability if you're screening, for instance. But then with such screening, you will filter out a lot of good companies potentially as well. And I think in the beginning, such screener helps because you don't need 100 stocks. You need only one stock to buy for the next month, let's say. But like us, we don't. Do you still use a screener? Really don't. I just have a list of stock universe. Let's say I'm interested in 100 to 200 stocks, something like that. I know them kind of, and that's where I just look through. Yeah.
Yeah, I think screeners have a place in the very, very beginning when you're at the start of the journey and
Yeah.
you're wanting to, like, you will miss out on some good companies, granted, but you will also miss out on some rubbish companies, and it's good to that because you kind of get these middle of the road companies that fit within a specific screener. You can get to know that quite well and understand the companies. But I think when you're going a little bit deeper, tricks work industry within the industry. So compare Mercedes, Volkswagen, compare them to Toyota, for example. Fine. But you can't compare Mercedes and Volkswagen to real income, or you can't
Or to Ferrari.
to Ferrari, or like, so it's quite difficult to pick metrics to do that. So yeah, I think, look, it boils down to those 5 questions we said earlier. And if you can answer all 5 of those and you're happy, then you've got
Go
a good
for it.
company on your hands. Yeah. Okay, last question quickly, and we will go with Trevor. He's asked us about investing in Eastern European regions. He heard us talk about the Slovenian farmer KRKA on one of the earlier episodes. I have to say it was a nice company. I looked into it a little bit. He has a position in some Hungarian pharma company. I can't even say the name of that.
Correct.
But yeah, look, but what are your opinions on investing in Eastern European regions?
So yeah, I live in Poland, Central Europe. It's a perspective, what is Eastern? But I think the markets are maturing, and I think there are a few companies starting to pop up here and there that may be attractive for investors to look into.
I think so, yeah.
I wouldn't say go full into it yet, but I think the markets are really maturing, and some companies are starting to have their international footprint. And also more and more people start to look good at countries like Poland and such, which means also that there's more likelihood, I think, or acceptance if they start taking over companies in Germany, Netherlands, and such here. Yeah.
Yeah.
So I think generally it starts to open up.
I think so. What I find difficult is, I mean, the companies are starting to do well, but if I open up my broker and look at the latest news, it's always Western Europe, companies closer to me that pop up first. I really have to look for Eastern European companies for that. It has to be fresh in my mind. And also, Europe is a big place, and we know even from Western Europe, you have UK, Ireland, even to Spain, the cultures are different. I mean, taxes, rules are different. Eastern Europe is so far away, I don't really have a good understanding of that. And we talk to people online and stuff that I think, and I'd ask someone and they say, no, that's not what it's like here. It's like XXX.
Yeah.
It's quite difficult. But I mean, he mentioned KRKA, the company, I would say. So I'm definitely not opposed to it, but I don't know if it would be big positions at the moment. I don't know if I have that conviction. But happy to have someone on the show that has more of a knowledge in this area and put us in our place and tell us about some of the great companies over there.
Yeah. Hey, we have 20 questions left, or even more from our listeners. What we can do is we can call the day here, but maybe still like later this weekend, if you have half an hour time to go through them, maybe do a special release or something like that.
Yeah, sure. Yeah. We can maybe do it tomorrow morning if we can.
Okay, awesome. Good.
Perfect. Okay, so I've got to run. It's 1 hour, 15 minutes. So we did well to keep it within that. There was a lot we got through. We do hope you enjoyed the show. I hope if you are invested in Bitcoin or anything else, you're not panicking. You're okay. You're not going to go broke. And stick to dividends, boys and girls. We've said that before. But again, look, thanks for listening. Appreciate all the questions. And we will see you all next week.